Hey folks, it's Dave Burrows. I want to thank everybody for tuning in today. Lots going on in the market, lots of question marks, probably a little bit more information, but really not that much. So what I thought we would do today is, as usual, kind of start from the top and work our way through what we're getting from our market signaling and how we're managing sort of markets in the accounts. Just to be clear, we continue to be in a structural bull market that started in 2013. We've stayed pretty steadily above this rising 200-week moving average. And despite the pullback that we saw in the month of April, we are still there. If we take a look at it a little bit closer, this is the same time period, 2013 to the present, spiked down during April. We're actually closed near the highs for the month, stayed above this rising 200-week moving average, but still, substantially off the highs that we saw in February. So, there's a lot that happens, as Diana puts it, between the wall and the wallpaper. And so we want to kind of tease apart what is longer-term trend, what is near-term noise. And when we look at the S&P daily chart, we can see that we traded down through the 50-day and the 200-day moving average in the beginning of March, prior to the tariffs being announced. We rallied up underneath the 200-day. And then, of course, as the tariffs got announced, we got the whoosh lower to the long-term uptrend that's been in place going back to October of 2022. Market has worked its way higher since then in lots of volatile up and down days. As we sit, we are now below the falling 200-day moving average. Markets had a pretty good bounce. We have not taken out the most recent lower high, which is just a little ways above, would be sort of above the 200-day. And so at this point, when I look at the S&P chart, it's still, to be honest, it's better. And it's good that the market settled down. Certainly it got technically oversold. But at this point, really, you can only say that this is a retracement bounce. It can turn into something more. We're able to get up through the 200-day moving average, through the previous rally little high here at the 200. That might change things. When we look at the NASDAQ 100, really big move lower. And we have rallied again back up underneath the declining 200-day moving average. 50-day moving average is moving sort of pretty sharply lower. And after, a string of up days, we've had 2 down days in a row here. And that sort of raises some questions. Now, in the meantime, what's been going on with investors, there has been just an absolutely massive private client or retail buying spree. So this is a lot of folks who feel that they are buying the dip, and maybe they are. This is a pretty significant imbalance. This is private clients buying. It's not professional managers, and maybe they've got this right. But, I keep a couple things in mind. We've said that we are at the point where we have hard data that is backward looking in the form of earnings and some of the first quarter data, which really wouldn't be affected other than perhaps some draw forward of demand to get ahead of tariffs. And then you've got the soft data, which is consumer confidence, CEO confidence, some of the near-term coincident data. And all of that comes in at a time when we are headed, the first 2 weeks, if we break the year up into cohorts, it's the 4th worst performing 2-week period, the first half of May. And we've got the second half of June coming at us. And very often seasonally, May, June to the beginning of July is a bit of a tricky period. So, we keep in mind that we are headed into a seasonally weaker period. If I look at the equally weighted S&P, all of these things have basically rallied back to the point where they broke into the tariffs. Now, there's been lots of discussion about deals, and we're going to have deals, and there's going to be big announcements. To be honest, I'm a little bit from Missouri on this. We'll have to wait and see. I think that there's a hope that there will be some deals. My guess is that the predilection for tariffs is not going to go away. So we'll have to see. But at this point, this is the equal weight S&P basically at the declining 50-day and above a declining 200-day moving average. When I look at earnings have been pretty decent coming through the quarter. And so the real-time data, again, the hard data, pretty good. Looking forward, we're getting revisions down. So we're getting revisions down for the second quarter. We're getting revisions down for the third quarter, revisions down for the fourth quarter. Companies like Ford saying, look, we have no visibility. And so we have to withdraw guidance or become more cautious. And so the current 2025 estimate has been coming down a little bit every week. So to put a point on the timing and where we are, I think is really interesting. This was a great graphic from Bloomberg today, and it was looking at really about the first ship to come into harbor in LA that left still prior to prior to the tariffs being announced. And this is what happened along the way. So left on April the 2nd, around the day we saw the 20% tariff announced. Got to Ningbo in China on April the 7th, and they announced a 45% tariff. Left Shanghai on April the 10th, 145% to max tariff announced. And makes its way to Long Beach, where it arrived last week on the 24th. So here's the value of that shipment, $564 million worth of containers, which will attract $417 million in new tariffs. So I listened to an interesting interview with the executive director of the Long Beach Port Authority. He said last week is the first week that ships would have arrived had they been leaving around the time tariffs were announced, and that last week they were down on average 50,000 containers a day. And that's before some of the most stringent tariffs were announced. So we think that there's going to be some interesting, harder data that will come at us, and we want to keep that in mind. So real divergence between the hard and the soft data. Okay, so last week I talked about the idea that in a tough market you can get very sharp rallies. They tend to rally to below the previous high. That is the case as we sit right now. But outside North America, it's actually pretty good. This is an ETF, the SPDR for the developed world ex-US. So sold off about 14%, which in fact, less than the S&P sold off from the highs, and less than the NASDAQ certainly from the highs. So held up better during the decline. But look at this, we're back. These are daily bars. For the last 4 days, we're now above the high from prior to tariffs. And this is a theme that we've been talking about for some time, because after you spend a long time in a consolidation range, in this case, 2008 through 2024, this is the first month that the holdings in this global ex-US ETF make new highs. The way I read that, that's the beginning of a new bull market. So I've had a lot of folks say, yeah, it's great that global stocks have been outperforming North America and US in particular, but probably that's a short-term thing. We know historically when global stocks start to outperform, it tends to happen for 5 or 10 years at a crack. And when we look around the world, there's lots of evidence of that. Euro Stoxx 50, which we've talked about for some time, monthly bars just keep working their way higher. Look at the month of April. Sharply lower, closed basically at the high for the month and now up in the month of May. Germany is a similar picture. Spain is a similar picture. Italy is a similar picture. Argentina, very constructive. Chile, we can look at, very constructive. India, very constructive. Japan, very constructive. So I think that there's a real message here. There is tremendous skepticism about global stocks. They say, well, there's no NVIDIA globally, just one in the US. And it's true. All these markets have low single-digit technology exposure, yet they're outperforming. They're all the targets of tariffs, yet they're outperforming. When something isn't behaving the way you would expect it to, given what you think maybe you have to question your premise. And strangely enough, here in Canada, the SPTSX, basically trading very close to highs. So we talked about the fact that the TSX has a sector weighting that is similar to the world index as opposed to the US, a much larger financials weight, larger industrials weight, obviously a larger energy weight. When I look around the world from a breadth perspective, there's expanding breadth everywhere. Now, the ones on the far right here, this is a distribution curve based on the percentage of stocks in each market that are in clearly defined uptrends. Europe, about 60% of stocks in uptrends. Japan, about 60% of stocks in uptrends. London, over 70% of stocks in uptrends. And so it's not everything. There are sectors that are doing well and sectors that are performing poorly, some that are more impacted by global trade, some that are less. But I think that this is an important linchpin. We've talked about this for a while. US dollar continues to weaken. So you think about that. We've had a decade of strong dollar. We've had a decade where the US market was the only place in town. Lots of global investors bought dollars, made money on the currency, invested it in growth stocks, made money in the stock market, and now we're underperforming on both. And frankly, this little bounce that we had over the last couple of weeks in the dollar looks to me like it's failing. The technical picture continues to weaken. It's not a surprise that the US is underperforming by the rest of the world by more than it has in a long time. So there's the TSX relative to the equally weighted S&P. These are monthly bars. TSX is just grinding higher on a relative basis month by month, despite the fact that we are the target of tariffs. MSCI All World Index, same picture. So this will have backing and filling along the way, but my guess is everybody should be considering and asking the question, do I have enough global exposure? My guess is no. Most of our accounts are about 10% specifically in our global fund. And then now in our equity mandates, we have purchased some global companies that are leaders in their group. But when I look at sort of what's happening from a market perspective, since November, the All World Index up about 8.5% total return, equal weight S&P down 8%. Qs are down 4%, TSX down 1%. Look at our global fund, All World Index since December 29th when we launched, up 17%, equal weight S&P up 10%, and the global fund, 80 companies, 40 growth stocks, 40 value companies, up 30.2%. So very, very happy with how that's going. So realistically, this is probably the early days of multiple currencies rallying versus the dollar. Warren Buffett made reference to it last weekend and said it would not be a bad idea to own some different global currencies. He's been a big buyer of Japanese stocks and European stocks. Euro versus US dollar, Japanese yen versus US dollar, Canadian dollar versus US dollar. We're seeing currencies everywhere, including Australian dollar and British pound. Now on the fixed income space, we've held that we saw a generational low in 2020 on 10-year yields. And it harkens back to what happened after 1950, when we had a long period of declining rates driven by trying to pay down debt from two big world wars. And eventually inflation picked up and the world changed and we saw rising rates for the next 30 years. And what performed well during that period was very different than what does well in falling rates. And I won't spend a lot of time on it, but some pretty tough data coming out of the Canadian real estate market. I think sales are down about 40% year over year. Prices are down for the month of April, 5%. If we look at the US, it's similar pictures. The last time we saw rates start ticking higher in the early 50s, inflation adjusted home prices didn't go up until after 1983, 30 years. So higher mortgage costs are likely to impact home prices, and we're not seeing a lot of mortgage applications. So money is moving from where it gets treated worst to where it gets treated best. We're seeing the early flows into Europe and the rest of the world. We're seeing some money flow out of the US. We're seeing money flow out of real estate. We're seeing money flow out of fixed income. Those are things that do well in falling rates. And I think we got a long way to go. 30-year yields are ticking higher. Scott Bessent, in his strategy, felt that if they could cut spending and they could slow the economy down, yields would come down and they'd have an easier time refinancing the $6 or $7 trillion worth of debt they've got to refinance this year. Bond prices are not supporting that. So bonds continue to be in a 5-year bear market. We know that from 1951 to 1966, bonds gave a 0% real rate of return, inflation adjusted. So that's really not the place. Commodities are behaving well and doing what they should do in an inflationary environment. They're a hedge. We had a first move higher from 2020 into the global tightening cycle. And for the last number of months, they have been providing the hedge in portfolios. And our balanced accounts, in our equity accounts and our macro account, we had a precious metals weight for some time. Gold has had a tremendous move higher. It got to 70% above the 200-week moving average. We do think seasonality gets tougher here. And so we did reduce our stake in precious metals to take some profits. We think that there'll be an opportunity to add some back at lower prices. But, it did exactly what it was supposed to do over the last couple of months. It provided an excellent hedge against falling prices in virtually everything but gold. But at this point, stretched above the moving average, if you look at the previous bull market, you had some consolidation each time it got kind of stretched. So whether it's here or a little bit higher, risk reward is not quite as good. We think that it's time for it to maybe rest a little bit, but we'll see. China's a big buyer. China was on holiday. They came back and gold moved smartly higher over the last couple of days. So it may well be that central bank buying and buying out of Asia, trumps this overbought condition, but we'll have to see. Seasonally, from May through sort of June and into July, there tends to be some weakness. We'll see whether that plays through. So commodities relative to the equally weighted S&P, outperforming now since 2022. It's a very mixed bag. Oil looks sloppy. Copper looks better. And gold looks quite good. Agricultural commodities are performing well also. I think this is a really interesting chart, and I know I keep putting it up, but the last time we saw an inflection point where gold started to outperform NASDAQ was in the second quarter of 2000 as the tech wreck got underway. So I'm not saying that's what's going to happen, but it does look as though, we have made the similar kind of turn. Gold starting to outperform and no sign of that ending at this point. That could be that gold just outperforms and tech does less well. It could be that tech has relative or absolute underperformance. It certainly is well owned, and gold is certainly not well owned. So it will take time for money to flow from one to the other. So look, we don't have to be everywhere. Our job's to be in areas that are seeing inflows, areas where we see money coming in behind us, where breadth is expanding. We like to own market leadership. We're always looking for change, new leadership to emerge, and old leadership to fade, in order to make sure that we're keeping the portfolios fresh. And as I've said before, in the absence of leadership, our job is to play defense. So, we are quite tactical. We did raise a fair bit of cash in the beginning of this sell-off this year, which has served us well. We have put a little bit of money back to work in some areas that are behaving better than others. And in particular, we're looking for areas where we're seeing relative strength and where we're seeing expanding breadth. That's, the definition of a bull market. And at any given time, there can be assets that are contracting. And at the same time, there could be assets that are the beneficiary of the flows of funds that are expanding. And it's our job to find those. So where we can find investable universes in asset classes or sectors and themes that are seeing net inflows, and where we can find securities that meet our business tests, that's where our portfolio should live. And, when we do see deterioration in breadth, our job is to step aside and to stop putting any new money to work. Frankly, which is why over the 6 months between June and December, we went from like 30% technology to 0. And we're really still seeing sort of sloppy action there. So we've got cash and we've been building our farm team. Now, in the near term, breadth has certainly been improving. So it's not that there aren't some things to do, but we also think that there's a tremendous amount of uncertainty. We're in a world where rates are rising. In our income strategy, it's well suited. If I go back to 2000 when we started the income strategy and take each of the periods where the yield on the 10-year was rising, it's a tough time to make money as an income investor because bond prices fall during periods of rising rates, as they did in each of these periods. But we're really pleased that in all of these rising rate periods, the income strategy has been quite good, especially over the last 4 years while fixed income's had a tough time. And it's because, we've been focused on more inflation-oriented assets. Number one on the list, financials. This is the XLF. I've been putting it up every week now for a couple of years because, frankly, it continues to outperform. Came out of this bear market in the end of 2020 as inflation started to rise, went sideways through the tightening period, and then month by month has been grinding its way higher. Came back very nicely last month. And if I look at just simple relative strength versus the S&P, relative strength continues to rise for financials. So it's not to say it didn't pull back, but it pulled back less than the market, and it's rallying more. And when you go under the surface, you see that insurance stocks are behaving well as a group. In particular, there's some real leaders like Fairfax, which is still the largest position at the firm. Definition of a leader. It can get dragged under the water, but as soon as the pressure releases, right back to the surface. And we've seen, the same thing for Intact and the same thing for Progressive in the US, property and casualty looking very, very strong. The other group in financials that continues to behave and surprise people are the exchanges. So TSX is a position now we've been in for about 18 months, better than 84% of stocks in the S&P over the last year. Again, right back to the surface quickly. Reported great earnings today. CME Group was an ad that we made after the decline in the market. It showed relative strength right away, and it's just marching higher. So really pleased with the financials in general. European financials, we talked about these over the last month. They really started to blast off. Again, came down lower to the 200-day moving average, very quick to make new highs and making relative strength new highs. Santander's the company that we put on in portfolios here, $112 billion in 40 countries around the world, and a real leader in digital banking and commercial banking and benefits in US, Latin America, Europe, major market leader. So Eurozone financials, though, just early days, new bull market. So, I know that when we look back at the financial crisis, companies like Credit Suisse come to mind, and UBS and BNP and others, but they did have, over a decade of restructuring to go through. A lot of the trouble was because there was disinflation. Now we're in an inflationary world, and banks benefit in an inflationary world, so should not be a surprise. Moving on, energy, the equally weighted energy index in Canada really does not tell the story. This is the 10 largest energy companies. Energy's been tricky. This is the IYE, which is the US Energy Index. It includes, large cap oil producers, refiners, infrastructure. Relative strength there has been very weak. You can see after the sell-off in the beginning of April, almost no bounce. And that's a problem. Frankly, oil is one of the issues, and we know that the Saudis just said that they're going to keep production high, and OPEC is going to keep production high. That's a pretty ugly looking oil chart. This goes back to July of last year. This consolidation has failed to the downside. So I think you really have to be careful on oil. But the natural gas opportunity, continues to play out. Expand Energy, which we've talked about over the last couple of weeks, basically coming back to new highs, which is almost a 5-year new high. Oil service, though not acting so well. Energy infrastructure is. So Cheniere Energy, we've heard a lot of discussion about the Trump administration wanting to expand their market share in the global liquefied natural gas market. Canadian companies benefiting from that too. Arc Resources, another one of our holdings, and the infrastructure companies supporting both Enbridge and TC Energy, are acting very, very well and paying us great dividends. So we're pretty comfortable with these companies. They've held in really, really well against a tough market. In the materials, also a mixed bag. Gold producers, obviously the star. And I think we're relatively early days in a new bull market here. Agnico keeps marching higher. Wheaton Precious Metals continues to march higher. They can certainly correct at any time, but we have to give them the benefit of the doubt right now. In industrials, another mixed bag. I mean, this is a very mixed market. This is the equally weighted basket of industrials. VIS is the ETF that we're using as a comparison. Traded down below the 50-day, but pretty quickly, 50-week, 200-day, very quickly back above. This is the Aerospace and Defense ETF XAR. Must have typed this in after the fact. Relative strength continues to perform well. In particular, aerospace has been very strong. This Howmet Aerospace we've been in, again, another great earnings report, another new high. This has just been marching higher for 18 months and continues to act well, better than 97% of companies in the S&P. We did add Embraer, the Brazilian jet manufacturer, and it's continuing to perform really well too. The environmental services companies, GFL and Waste Connections, Republic in the US, which we don't own, are making new highs. So lots of strength here, but you really have to be careful in a couple of the other groups. We did add GE Vernova back. We got stopped out of this in the sell-off. It stabilized very quickly and relative strength started to rise, technically above all the moving averages. As a reminder, GE Vernova makes turbines. In particular, used to be, people owned it for wind turbines. We own it for gas turbines. We think that there's going to need a tremendous amount of new energy to support AI and the cloud and technology in general. And we like to see the fact that this has come back and made a relative new high very quickly, better than 98% of companies in the S&P. But machinery in general continues to underperform. Transports, looking sloppy and probably not going to get a lot better if we see a slowdown in shipping. So again, pick our spots. Communications continues to act well. Announced this week potential tariffs on foreign produced movies, with some concern how it might impact one of our largest holding, Netflix. Frankly, it didn't budge. So Netflix performed well. Some question as to whether that can actually be enforced. Technology continues to be a relative underperformer, even though there's been a good technical bounce. Moving averages are all moving lower, not ready to make any new commitments here. Semiconductors as a group, worse than technology overall, below the declining 50-day, below the 150-day, below the 200-day. Relative strength continuing to make lower lows and lower highs. Not to say it can't change, but at this point, doesn't really make sense to commit new money. And gold versus semis, rather be in the golds, frankly. Other big groups that are performing poorly: healthcare, relative strength, new low today, lower lows and lower highs. Home building plays into that residential real estate theme, very weak performance. This is home builders and construction materials, no exposure here. I mentioned machinery, durable goods, really quite weak. I think these things point to the risk that there is a real economic slowdown. Oil, machinery, transportation, they're all very economically sensitive groups. Now, in the materials, chemicals, we did buy Nutrien because the agricultural stocks and the agricultural prices have been strong, but in general, and I don't have it here. The basic materials and chemicals group, in general, is pretty weak, also very economically sensitive. So this is really about, I think, picking our spots. Consumer discretionary, no strength here. Obviously, tariffs are going to be an issue, and so we're staying away. We do only really own still sort of consumer staples. and they've been a great place to be. Loblaws continues to mark its way higher. Dollarama continues to mark its way higher. Costco continues to perform well. So, there was a lot of positions that we got stopped out of. The majority of our positions have come through this really well. When I look at our sector weights, they're not too different. Financial still our biggest weight. Energy, gas, and pipelines in behind. Our materials weight, which we took down a little bit from a month ago, just took some profits on some of the extended golds. We've got industrials up a little bit because we added the Embraer and GEV back to the portfolios. Corporate bonds and government bonds, those are placeholders. We do own them in our balanced portfolio, but these are short-term bonds that are liquid that we can use along with the cash. We took some of our cash and added some short-term bonds in the near term. And then when we go down to the consumer, it's really a very lightweight. Communications a lightweight, utilities a lightweight, healthcare a lightweight, technology an exceedingly lightweight. So these are pretty polarized portfolios. I'm reasonably happy with how things are going. A typical account spread across our pools is off about 1% on the year. We've got lots of cash and flexibility if things were to get more difficult. This has been consistent the last little while. This was today at 3:00 in the afternoon. Income portfolio is up 63 basis points for the S&P, down 50 beeps. Equity portfolio up 40 beeps versus S&P down 50 beeps. Our global fund down 21 beeps. The macro portfolio up 60 beeps. So I think by being in the right spots and being tactical, we're in a decent position. Things we're watching for from a risk perspective, continuing to watch credit spreads. They widened a little bit. And I'm continuing to watch the fact that volatility has stayed elevated above sort of the bull market range. Now that makes sense. There's question marks. Here we are in the beginning of May, the old saying, sell in May and go away. We'll see whether that follows through. I think that we continue to be cautious. Things that are highly economically sensitive, things that are tariff sensitive, so the consumer, and frankly, things that are crowded after 10 years of a bull market and growth stocks, things that could be vulnerable if global investors just choose to pull their horns in a little bit and repatriate some assets home. We are in general hedged for inflation, and we've got lots of flexibility with the cash that we've got sitting in accounts. So, off the long-term chart, it still looks okay. We'll see. If it gets tougher, we can always be more defensive. That's our tendency. And that's sort of where we are today. I'll just check and see what kind of questions we've got. Let's see what we got here. What is our view of silver and silver stocks? I think long-term, they are probably going to do very, very well. As I mentioned, we reduced our precious metals exposure a little bit a couple of weeks ago. Stocks have pulled back a bit, although they were quite strong today. We'll see if when gold starts its next leg higher, probably silver stocks really participate. So companies like Pan American Silver, we own Wheaton Precious Metals, and I think about 45% of their revenue comes from silver. And so that's our exposure there. Another question on gold and precious metals. I think the question is, why are they up over the last couple of days? I think that the Chinese market was closed for a couple of days, and a lot of buying has been coming out of the Chinese central bank, and frankly, Chinese investors. North American private investors have been selling this entire rally. So just to be clear, virtually no inflows into the ETFs that buy the precious metals miners. And I understand it's been 10 years since they performed well. So there's general skepticism. And as we saw, tremendous buying of growth stocks over the last 2 weeks as the market has bounced. And I am concerned that those folks are going to wind up stranded in an asset that in general is seeing outflows. So something to worry about there. Global equities, I think should be sort of a minimum of 10% of portfolios currently. My guess is we will continue to take our weight higher. If we get some back and filling in the North American markets over the next few weeks, that would be an opportunity for us probably to add some more. And one more question on India. Is India a value play now? It really depends on what you're looking at. You know, the Nifty 50, the 50 biggest companies are broadly owned and not cheap, but probably growth is higher. You know, growing consumer class, a growing number of sort of financialized population. So lots of opportunities there, and there's lots of opportunities around the world in general. So we have our eyes wide open. Our new global fund is we take the 895 constituents of the MSCI All World ex-US Index. We screen it for quality, and then we have built a cohort of 40 securities that are liquid and rising relative strength, and we rebalance that quarterly over 4 quarters so that that 40 names turns over the course of each year, because relative strength doesn't persist for much longer than 12 to 18 months in general. And then we have a value component, which is 40 companies that have started to show price strength. So we're buying accelerating value companies and rebalancing once per quarter over 3 years for that cohort, balancing out decelerating names and balancing in accelerating names. And it's a list that is more eclectic. It looks a little bit less like the index, and we think is really well suited to this environment. So I got that there. One more question from Paul. Cash crop grains are not profitable right now in North America, also subject to tariffs. I wonder about the fertilizer and input supplier nutrient. What do you see differently? Well, look, you know, the overall pricing is showing some improvement, and there's going to be friction in trade. So we think that people have held off over the last couple of years on fertilizer. We think that can certainly pick up. We're seeing it across the board. All of the major fertilizer companies are seeing strength. So we didn't start with a big position. As you know, we're feeling a little cautious in this market. So we started with a partial position. And should it continue to perform, then we will look to add. But great question. With that, I think we got everybody. Okay, so I am going away over the next 2 weeks from this Friday. And so Diana and James and Brian and Amit will be running the weekly call next Tuesday and the Tuesday following. If you got questions you wanted to answer, you know, please send us an email or give us a call, and I'll certainly be, you know, online and in touch, but I will be out of the office for 2 weeks. So if you got any questions and like to talk about something, this week is the time. Hope everyone's having a great day and a great week, and we'll look forward to seeing you again shortly.